Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin this hour with stocks looking to bounce back after a weak payrolls report fueled rate cut expectations. Ed Yardeni of Yardeni Research writing traders might be starting to take profits before going on their August vacations. They might also be betting that September could be a weak month for stocks. Ed joins us now. Ed, let's start with the growth picture and just your reaction to Friday's labor market data, especially those massive downwards revisions. For you right now, is it a cause of concern?
Not really, not the way the market took a dive, and I'm happy to see that the market may very well rebound today. The reality is we did have a lot of uncertainty during May and June when we had these big downward revisions. Honestly, it seems to me the downward revisions actually make more sense, given that if I was an employer during May and June, I wouldn't have fired anybody, but I wouldn't have hired anybody, given all the uncertainty unleashed by what I call Trump's tariff turmoil. And so, yeah, all in all, those numbers didn't surprise me all that much, with the benefit of hindsight, obviously. And then, of course, we did see that the labor supply, the labor force, has been kind of flattened down since the beginning of the year. So this is a combination of weakness in demand that may be temporarily related to the turmoil on tariffs that should, I think, abate over the next few months. And at the same time, we may actually have a shortage of workers.
Well, the president didn't like the jobs number on Friday, and he fired the head of the Bureau of Labor Statistics. Do you think that undercuts market confidence?
Well, this is a very bad situation. The president, in my opinion, shouldn't have done that. I agree with what your colleague Danny just said, and that is he should be throwing more money at the Bureau of Labor Statistics so that they can do a better job sampling workers and the unemployed to see what's really going on here. Firing the commissioner does raise some questions of the confidence that people are going to have in the data, especially if he puts in a loyalist as a statistician, which he's likely to do.
So what do you do then, Ed? If you get a loyalist put in as a top statistician there, do we still trade on the data? Do you take it more skeptically? Do you use private measures more? How will it change how you interpret labor market data?
Well, yeah, I think right now there's a lot of skepticism about the labor market data, the employment data, I should say, because of what you mentioned before, the fact that response rates have gone down. And look, the economy moves a lot faster these days, and I'm not sure the statistical techniques that the BLS has move as rapidly. So I would throw more money at them rather than become partisan about it. So all I'm saying is the data was already suspect for other reasons. And we've all of us economist types have looked at all the employment data, both private and public. So I think nothing dramatically changes in terms of the way the markets look at data.
Even so, Ed, nothing dramatically changes, but Friday did demonstrate a vulnerability in the market with that huge move in the front end. You could even say what happened with copper prices demonstrated a vulnerability. Given that we've had this slow melt up to the summer, you're still bullish, Ed, but are you concerned about some of these short-term blips that traders aren't properly hedged for?
Well, you quoted me saying that a lot of traders, a lot of investors are going on vacation. They certainly don't want to be exposed to the volatility of the market, at least not from a trading perspective. So I think we're going to see a lot of that kind of activity slow down. I think it already has slowed down. Maybe it started that on Friday. As some people said, you know what, I'll be taking vacation for the next week, 2 weeks. Let me just close my books here. And then, of course, there is a seasonality issue. Septembers have a tendency to be weak months. So I wouldn't be surprised if this market just kind of chops around here in August and September, and maybe we make some sort of low or bottom in October for a year-end rally.
Good luck to anyone who's trying to take a vacation with all these headlines coming out. Ed, also this week we have this new deadline when it comes to the tariff rates on Thursday. Do you think the market is ready to basically put the trade war behind them?
I think the markets would love to put the trade war behind them, and I really thought that by now the president would really be in the same camp, because he's got to start focusing on the midterm elections next year. He does love to talk at these large conventions, these large rallies in sports stadiums, and he's going to need to do that in order to shore up his Republican Party during the midterm elections. And he's got to really start to focus on just saying what has been accomplished and avoid doing things that might backfire on the midterms. I think the other issue, of course, is the courts are probably about to rule that he doesn't really have the legal authority to do what he's been doing. I don't know if it's going to go all the way up to the Supreme Court. The appeals court has 11 judges, and if all 11 of them rule that way, which is possible, the Supreme Court may not take it up. So we may be entering even a more volatile period with regards to what's going on here on the tariff side.
But you don't expect the tariffs to go away, do you? Because there are other tools they can use to enact them?
There are other tools, but they're not as quick or efficient as the emergency act that he called upon that the courts may rule. He just doesn't have the power to declare an emergency when there doesn't seem to be an emergency. Again, I think he and the administration may conclude that it's time to downplay the whole thing and move on.
What does that mean for corporate America, Ed? Some of these companies are just starting to wrap their heads around what it means for them. Or you have the likes of Amazon last week who said, we just don't know what's going to happen moving forward. Yeah. Is there enough clarity after Friday for corporations to move forward with things like spending and hiring plans?
I think we have to see what the courts rule and how the administration responds to that. The reality is, if we just take it at face value that the president wants to basically achieve a 15% tariff across the board on everybody and raise something like $400 or $500 billion, well, the corporate income tax raises about $600 billion. In effect, the tariffs are a tax, and they're a direct tax on importers, businesses, and so it is a negative for corporate profitability. And again, we've heard some bad news out of GM and Ford anticipating this, but other companies say we just don't know enough to really figure out what this is going to cost us. So that's still a known unknown.
But still a little bit more clarity in terms of the bottom line rate for tariffs. Yeah. We do have a weakening jobs report on Friday. Do you think the Fed is in position to cut in September?
Well, the market certainly thought so on Friday. Maybe today there'll be a change of opinion. I think on Friday we got the probability of a rate cut, according to the CME FedWatch tracking tool, going up to a 90% probability. Then over the weekend, that actually simmered down by the end of Friday down to 80%. I wouldn't be surprised if there is no rate cut on September, because we still have a batch of data up ahead here, particularly on the inflation front. We are seeing that the tariffs are having an impact on inflation. A lot of people saying, it's not there, but the reality is, if you look at durable goods inflation, durable goods prices typically fall. That's what they did before the pandemic. Then they had that inflation spike, but then they came right back and started falling again, and now they're rising again, mostly because of the tariffs.
Ed, thanks so much for your time this morning. It's a great point. Ed Yardeni of Yardeni Research. IPOs are making a comeback this summer, with the latest Figma share surging more than 250% in its debut last week. So excited for this conversation. Joining us now is NYSE President Lynn Martin. Lynn, good morning. Thanks for joining us.
Thanks for having me.
So you told John, Lisa, and myself in May that you saw, quote, unprecedented levels of volume following the April 2nd Liberation Day. Yeah. But for the IPO landscape, you were optimistic, but the timeline was shifted out. Where are we now in that timeline and that pipeline?
Well, I think as a result of the successful deals we've been able to bring to market, really starting in that end of May timeframe, but most manifestly over the last 2 weeks when we had 7 IPOs, I think it's fair to say that the markets are open for IPOs.
Are markets open for all IPOs, though? Do we still need to be selective among those that are being brought in? And they need to be tech companies, for example, or can we start to see some of the smaller mid-caps come back, too?
Yeah, we've seen a variety of sizes and companies across different sectors come to market in the last few months. Tech, in particular, has, as you point out, had a great reception in the market. You know, in the last 2 weeks, we saw Nielsen IQ, we saw McGraw-Hill, we saw Figma, as you just had the screen up, and then a couple months ago, we saw Circle come to market, also Hinge Health and Mountain. So some really tech-led companies, but mostly pretty much all sectors the market's ready for.
It is a bit of a split screen, though, Lynn, because you start to have some IPOs coming back.
Yep.
And at the same time, you have these private equity players coming up with liquidity solutions that just allows companies to be private for longer, be it secondary funds, be it perpetual capital. And their argument is companies just don't want to be public, and we're giving the option not to be. Longer term, does that hinder IPOs?
Well, I think what it means is that the companies that come to market are better companies. You look at the companies that have come to market, it's not the first time that they've been in the news about an IPO. Look at Circle, for example. They were talking about going public back in 2021. When they came to market, though, they're a better company. They have a more refined strategy, a more refined P&L, a story for the investors that generates a tremendous amount of excitement. And I think what you're seeing with the reception of the companies that have come to market is that pent-up demand in the public markets, that pent-up excitement in the public markets for new issues to come to market. It's something that I talk with long-only investors, something I talk with retail about, how they really want to see these new names, these growth companies come to market to add to their portfolio.
That pent-up demand, was it being held back because of regulation in Washington?
It was really being held back because of volatility and uncertainty in markets. There have been a variety of events that have occurred over the last three and a half years, wars, geopolitical uncertainty that have fueled that volatility. Now that there is more certainty around the geopolitical landscape, more certainty around the market and the trajectory of the market, that's why you're seeing these companies finally come to market.
How is the change in regulatory leadership, though? The SEC regulates the NYSE. How has that potentially changed your business going forward?
We're very optimistic. We had a great relationship with the past administration and the past SEC, but we're very excited about...
Paul Atkins, though, is very different than Gary Gensler.
He is, and we've had a long relationship with Paul Atkins. This isn't Paul Atkins' first time in the SEC, and we had a very productive working relationship with him. We've already had a very productive working relationship in the short time that he's been chair, and a lot of the modifications that he's looking to make, I think, are going to benefit the public markets.
So we have a moment where public market volatility has started to ebb, but even so, you have the rebirth of meme stocks. And you have these weird things happening where you have Open Door, for example, on one day can account for 10% of all equity trading volume. What do you make of just the health of these markets at this moment as some of that starts to bubble up?
I think the markets are incredibly healthy. I mean, our markets are the envy of the world, the breadth, the depth, the liquidity, the trade certainty. Any one day, though, there could be excitement about a different name. I think what you're seeing is a lot of the pent-up demand looking for the new issues and new things to trade.
It's very different, though, than 2021, where those retail investors had all the money to go. So when you look at that, you're like, okay, this is just a temporary phenomenon, or do we just need to get used to single names, getting this wind sweep of various excitement built up online, and that's just the new normal we live in?
You know, I really can't speak to what's driving a stock on any given day. Certainly, the social media and the conversation around stocks overall, I think, is actually a good thing. It means that people are interested in investing. They're interested in adding to their portfolio. They're also interested in diversifying their portfolio.
Speaking of diversification, on Thursday, AT&T says they're going to have this dual listing in the NYSE in Texas. What's the business like in Texas?
Yeah, well, we're very supportive of all of the changes that Governor Abbott has rolled out in the state of Texas to really foster that pro-growth environment. Since we announced NYSE Texas and launched the exchange, which was the end of March this year, we've added 20 new listings to the exchange. So we're very optimistic and grateful for Governor Abbott for really leading the way on pro-business atmosphere.
Do you see more money leaving New York, though?
You know, I don't know. I don't think so. I think New York's always going to be an important epicenter for markets, but I think it's interesting, the pro-business moves, and then ultimately what the pro-business moves in Texas will lead to on the federal level, more than anything.
Lynn, thanks so much for your time this
Thanks
morning.
for having
me. Great insight. NYSE President Lynn Martin. Meyer of Mastercard Economics Institute, writing, consumers are the heartbeat of the economy and they are resilient. Michelle joins us now. So you say they're resilient. What kind of cracks, Michelle? And good morning. Thanks for joining us.
Of course.
Do you think the economy is seeing right now when it comes to the consumer?
Well, I think it goes back to what we learned over the last few days on Friday with the jobs report, that clearly there has been an uncertainty impacting the economy that has mattered for companies when they think about the labor demand numbers. So the slowdown in job creation within the May and the June report looking distinctly different than we thought it was in real time shows that some of that uncertainty mattered, that there probably was some pausing in terms of the pace of job creation. But importantly, there's very little evidence of firing happening, whether you look at the jobless claims numbers or you look at the JOLT survey. And I think for consumers, what that results in is a labor market that is still supportive, right? An unemployment rate of 4.2%, wage growth that is still running above underlying inflation, even with some of the tariff inflation impulses starting to move in. So consumers are managing this, I think, quite remarkably.
And things like sales and the earnings we've seen look really strong.
Yeah.
But Andrew Lapthorne over at SocGen noted that 2/3 of the companies in the S&P reported declining profit margins. In other words, for now, the companies are eating the higher costs. If they turn around and start to rise and raise costs, will the consumer still be resilient?
Well, I think it's happening, and it's happening slowly, and this is important to keep in mind, which is that I think relative to the initial expectations and the fear of tariffs was that it was going to impact the economy immediately, and all of a sudden consumers wouldn't be able to get items or they wouldn't be able to afford certain goods. And the reality is that it's happening slowly. It's moving into the economy. It's starting more on the supplier side than the companies, and into consumers. And if you look at the last inflation report, it's starting to show in certain categories. A lot of the durable goods, discretionary goods, whether you're looking at appliances or auto tires or even into apparel, it's starting to show up. So I would argue that consumers are already starting to face some of those higher prices. It's happening gradually and it's happening uneven, which means that consumers still have some choices in terms of how to navigate this and move around some of these price shocks.
In terms of the unevenness, it's also interesting to look and see what the hottest parts of this economy are. And it's hard to argue it's anything but tech and AI.
Yes.
But these are the very companies that are firing on a headline level and only hiring at the top echelons where you get the most pay. When you look at that trend, do you see what you're talking about in the unevenness? Does it start to get exacerbated by some of these tech moves?
Well, I think the fact that you're seeing all this investment focused on technology is actually a really positive secular trend that hopefully could help get us through some of this cyclical adjustment that's happening as a result of tariffs. But yes, to your point, what it also does is it creates a lot of wealth in the economy. So if you look at the equity market, we'll see what results today, but the trend has clearly been very positive, notwithstanding Friday. And therefore, that's positive wealth gains, and those positive wealth gains will filter into consumer spending amongst the cohort that can realize those gains, that can invest and can see that wealth creation.
That's the upper echelons of society. Correct. Do you feel like we're going into a K-shaped economy? Or are we just already in one?
You know, that's been a conversation that's been on and off for the past several years. And I think the reality is that there's always an unevenness about any business cycle. And I think when you consider the start of this cycle coming out of the pandemic, it was certainly one that was much more driven by lower income consumers than we have seen in recent history because of the amount of stimulus that pumped in, because of the movement in the labor market, red hot labor market, very strong wage growth. And that has shifted over the last 2 years or so, where lower income consumers aren't seeing that same wave of stimulus clearly. And wage growth has slowed a bit more for that population than for others. And the balance sheet is just frankly not going to be as supportive.
We have a viewer writing in, loving to get your thoughts on real PCE turning negative in the first 6 months of 2025. They say it's the first time we've seen that since 2010, excluding, of course, the pandemic.
Well, real PCE turning negative, I think we can debate, but certainly there's been a slowdown in measures of real PCE if you look at the GDP reports in Q1 and Q2. And that reflects what we were just talking about in terms of higher prices, right? The consumer has already started to see some of those price increases. And what that does, it means that real spending starts to slow. We saw it during the pandemic inflationary burst. The nominal economy was running at extraordinarily high levels, and the real economy was much, much slower because consumers and companies had to absorb those higher prices. So when you have a price shock, today is a lot more muted than it was during the post-pandemic period. But the real economy has to moderate in order to absorb some of those inflation gains.
Michelle, you look at a lot of alternative data sources.
Yeah.
And right now we're in a moment where we're starting to question the official data we're getting, not least of which if we do get an appointment at the BLS, which is blatantly political. If that does happen, would you be prepared to lean in to those alternative data sources? Does it change the inputs that you use to see where we go from here?
Well, I am a big, big advocate of many different data sources. At the Mastercard Economics Institute, we're sitting on one of the most amazing ones, which is understanding the consumer in real time by looking at consumer payments. So, yes, I think it's extremely important to rely on many, many different sources and forms of data. The great thing about being an economist here in the U.S. is that we have a very long time series of data coming out of the government, which has been an extraordinary support for us in terms of how we think about modeling the economy. But the economy is dynamic, the economy is shifting, and therefore I think you have to be really mindful of using a variety of different data sources. So trying to see, really that pulse of the consumer in particular and how consumers are evolving their spending trends has been a critical impact for us, and I think a real distinguishing factor.
With the president, though, firing the head of the BLS, do you still put credibility in the jobs report going forward?
I think you do. I mean, look, I think there's a huge staff of economists at the BLS that are doing their job.
The commissioner doesn't really even touch the data until the very end.
And they've been doing their job for decades. And I think that's hard to shift overnight. But, they're contending with the fact that the response rate has been declining for surveys across all different types of government data. And that's a challenge. So I think continuing to adapt, continuing to find new methodologies, new innovative ways to gather data will be really important.
Michelle Meyer, thank you so much for your time this morning. Of course, Michelle Meyer of the Mastercard Economics Institute. New York Fed President Bill Dudley writing this morning, quote, "Don't be fooled by the drama. In terms of how the Fed manages the economy, it's mostly a tempest in a teapot." Bill joins us now. All right, Bill, I won't be distracted by all the drama, but there's a lot of noise right now coming out of Washington, D.C. When it comes to who could potentially take this role, do you think this administration wants to put in a shadow Fed chair?
I don't know if that's their intention or not, but obviously the next governor appointment that seems to be on a faster timeline than we thought will be important because that person could end up being the next Fed chair. And so people will pay particular attention to who that person is and what their views are.
So in that case, and I know as you write, Bill, that you did see Waller's desire to succeed Powell and Bowman's thank you to Trump for appointing her as part of the reason behind their dissents. Bill, if I could just push you on that, because many people have looked at this economy and said there are reasons for a cut, and Friday vindicated that with weaker labor market data. Is there an issue where we look at all these dissents and say they are just political, or is there real evidence that perhaps the Fed should be leaning towards a cut?
Well, the Fed is leaning towards a cut. If you go back and look at the June summary of economic projections, everybody sees the path of rates is going downward. It's just a question of magnitude and timing. So the degree of disagreement within in the Fed is actually, I think, dramatically overstated because everybody thinks the next direction of moves is down. Just a question of when to do it and how to manage the inflation risk caused by the higher tariffs.
So, Bill, the direction of dissent or the amount of dissent is overstated. So, too, is the ability for this FOMC to be swayed. What happens, though, if the data becomes less reliable, if a more political figurehead is put in at the BLS? Bill, you've been in the room evaluating this data with colleagues. How does that change in the Fed's evaluation of said data if changes are made at the Bureau of Labor Statistics?
Well, it depends if whether the changes made at the Bureau of Labor Statistics actually result in poor quality data or not. Obviously, if the data, is rigged, then the Federal Reserve is going to have to go to other sources of data. There's a lot more data available now than there was in the past. There's a lot of data that you can scrape off the internet, for example. So I think that obviously we want the BLS data to be excellent quality and trusted. That's very important. And so we have to keep an eye on that. But the idea that the Fed would be sort of unable to conduct monetary policy because the BLS data was corrupt, I don't think that's the case.
Well, going to the BLS data on Friday, now the average 3-month payroll gain went from 150,000 before Friday's release to now just 35,000. Going back to those two dissenters, doesn't Governor Waller have a point? The crack has already emerged. Is the Fed going to be behind the curve?
Well, I think the Fed probably will be behind the curve because the tariffs create so much uncertainty about what's going to dominate, the risk of inflation or the risk of growth. Everyone said that tariffs are going to push up prices and push down economic activity. And the question is, which is going to predominate? So the fact that the Fed might be late is because the tariff policies created this tremendous uncertainty about which force is going to be dominant.
Jay Powell really honed in on the unemployment rate last week, talking about the fact that's the main number he's going to look at. We did see it tick up to 4.2%. What do you think the line is for him where the unemployment rate ticking to what would get him really uncomfortable?
I think, a couple more tenths would definitely get him uncomfortable because then you'd start to think that the whole labor market was starting to give way. And when that happens, it can be a self-fulfilling prophecy because it scares people. They pull back on their spending, and that makes the labor market still weaker. The important point that Powell made, though, is it's not about the payroll employment changes. It's basically how that actually reflects in the unemployment rate. Because what's basically happening this year is the growth rate of labor demand has fallen, but the growth rate of labor supply has also fallen dramatically because of deportations and the crackdown on immigration. So both sides of the labor market are less robust than they were before.
And the jobs that were added, Bill, about 75 of them came from healthcare. The cyclical parts of the economy really were not adding jobs. The lack of breadth in Friday's data, does that concern you at all?
Well, I think, I'm worried that we're going to be in a sort of stagflationary environment where we're going to have both higher prices and a weaker economy. And the question is, which one do you put more weight on? I think the direction of rates is down. I think the question is just, at what meeting does the Fed finally see enough evidence to warrant a cut? As I said in the piece that I published in Bloomberg Opinion, there's not that much disagreement about the Fed. It's all about timing and magnitude. It's not about direction.
Well, what happens if, Bill, we have Adriana Kugler stepping down, so that's certainly a Trump appointment, and then you get Chair Powell who decides not to stay on as a governor through 2028. In total, you add to that both Bowman and Waller. That means 4 Trump appointees on the FOMC. Does that in aggregate just mean, at the very margin, a more dovish shift to this Fed?
Oh, absolutely. I mean, I think, when it's a close call in that kind of situation, the ties are going to go to the doves. But at the end of the day, the economy is going to drive the story. I think, the chairman can't take the Fed wherever he or she wants. It depends on how the economy is motivating what's the right thing to do in terms of monetary policy. The chair has to convince the rest of the FOMC to go along. Now, obviously, if you have 4 governors all lined up on one side, that gives the chair quite a bit of momentum to get his or her way. But, I think the Federal Reserve presidents are going to continue to vote their conscience in terms of what's right for the macroeconomy.
The markets this morning are rebounding off of the lows on Friday, following the fact that everyone's starting to bake in this idea of a September rate cut. But, Bill, what if we get a hot CPI print? What's going to happen then?
Well, I think it's too soon to say that we're going to get a September rate cut. I mean, we just saw how the market for September has moved dramatically just in the last week. When Powell made his remarks at the press conference, people said, "Oh, they're not going to cut in September." And then we got the week in payroll employment report on Friday, and everyone said, "Oh, they are going to cut in September." So it's a long time between now and September. I think the prospects are pretty good that the Fed's going to cut rates later this year. Whether it turns out to be September or not really is going to turn out to depend on the data.
Bill, to what degree could this just be a post-Liberation Day fallout, the jobs data we've had over the past 3 months, and something that might rebound in August, given more certainty on which tariff levels are being set?
I think you're making a good point that the tariffs have caused people to sort of stand back in terms of business hiring and business investment because they don't really know what the landscape is. And as we get past August 1st and hopefully get more clarity on what the tariff packages are going to be country by country, that presumably will make businesses more willing to move forward in terms of their investment and hiring plans. So it certainly could go that way. Or it could go that the higher tariffs are raising prices, that's crimping real income, and that's affecting consumer spending, and that's leading to weakness in employment. That's going to motivate the Fed to cut rates. We still don't know which direction is going to predominate.
What we do know, though, is we know most of the rates. There's a handful of countries potentially could get better deals and better rates. But for the most part, we do know the rates going forward, and they're going to take effect this Thursday. How much time do you think the Fed needs to see this work through the economy?
Well, I think the Fed would like to see, a lot of time, a lot more than, 6 weeks to the next FOMC meeting. I think they think it's probably going to take, 6 months to get to see the full effects of the tariffs, because it takes quite a bit of time between the good landing on U.S. shores and it actually ending up being sold in a department store or another retail establishment. So I think the Fed thinks it's going to be a slow process. And Powell basically said that at his press conference last week.
Former New York Fed President Bill Dudley, thank you so much for your time this morning.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.